Okay, let's look at the data. Right now, the market is showing us a critical divergence. On one hand, you've got this extreme pessimism. Stocks are just getting hammered down to 52-week lows. But on the other hand, you've got extreme conviction from short sellers who are betting everything on a further crash. So when these two massive forces collide, volatility is coming. Let's break down what this structural anomaly is really all about.
And this slide right here, it lays out the core conflict perfectly. Over on the left, you see the market sentiment, pure pessimism, with stocks hitting rock bottom. But on the right, you see the institutional play, extreme conviction. We're talking about short interest climbing past 25% of the float. That's the entire pool of shares available for trading. Look, this isn't just a little bearish bet. It's a huge, crowded trade that creates a very, very fragile situation.
So you have to ask yourself, right, what happens when these two forces actually meet? When the entire market is basically writing off a stock, but the institutional shorts are so packed in, so heavily positioned, that any little unexpected move could set off a massive chain reaction. Well, that's the anomaly we're digging into today.
This divergence creates this incredible structural tension deep inside the market's plumbing. It's an environment that's absolutely high risk, no doubt about it, but it can also be extremely high reward. And to really get why, we need to look at the single most important ingredient fueling all this tension, short interest.
So what is short interest, really? It's not just some number that tells you people are bearish. No, it represents a future liability. Every single one of those shares sold short must eventually be bought back to close out the position. Just think about that. It's like a giant pool of guaranteed future buyers. The catch? Their trigger for buying is pain.
And here's a look at just how extreme that liability can get. According to MarketWatch data, you've got companies like Eurogen Pharma and Symbotic with nearly 30% of their entire float held short. This isn't a small hedge. This is a massive, concentrated bet that these companies are going to fail. And that, my friends, is the fuel for a potential wildfire. All of this heavy short positioning creates what we call a coiled spring effect. And the more short sellers pile in, the more that spring gets compressed, and the more explosive its potential energy becomes. So the big question is, what's the mechanism that could suddenly release all that stored energy?
And that release mechanism is the short squeeze. It is a brutal feedback loop. It starts with some kind of positive news that causes an initial price spike. That spike puts pressure on the short sellers. As they're forced to buy shares to cover their positions and just stop the bleeding, their own buying activity creates more demand. That drives the price even higher, which forces even more shorts to cover. It's a vicious cycle for them and an incredibly powerful one for anyone on the long side of the trade.
So let's break down the pathway. First, step 1, you need the fuel. Well, we've got that in spades with the high short interest we just saw. Step 2, you need a spark, a catalyst. This could be anything, really. Better than expected earnings, some big news, a new contract, something that brings in fresh buying volume. Step 3, that new volume pushes the price up, and it starts tripping the stop losses for short sellers. And finally, step 4, their forced buying, their covering, becomes the rocket fuel. It creates a parabolic spike as they all scramble to buy a limited supply of shares at the same time.
Now, it is really easy to frame this as some epic battle, retail traders versus the big bad hedge funds. But that's a massive oversimplification. This isn't about heroes and villains. This is about understanding the cold, hard structural realities of the market and reading institutional flows for what they are, calculated bets.
As Andrew Left from Citron Research, one of the most famous short sellers out there, pointed out in an interview, the narrative always paints the shorts as the bad guys. But from a purely analytical standpoint, we have to be objective. Their position is just a data point, a very, very important one, that can signal a major dislocation in the market. And we have to respect why they take these positions. It is almost never random. There's usually a deep, fundamental bear thesis behind it. They've done the homework and believe the company is in trouble. Other times, it's just a hedge against other stocks they own in the same sector. Or it could be part of some complex arbitrage play. Understanding their motive is absolutely key to figuring out if that coiled spring is going to snap back or if their bearish case is actually going to play out. All right, so with all this potential energy just building and building, how can we spot a potential turning point? This is where we shift from the big picture market structure to actionable technical analysis. We start looking for specific signals that the selling pressure is finally running out of steam and a reversal might be on the horizon.
The first key signal we're looking for, which comes from Research 360, is the hammer candlestick. This is a classic bottoming pattern. What it shows you is that sellers tried to push the price way, way down during the day. But then the buyers stepped in with so much force that they drove the price all the way back up to close near where it started. It's basically a picture of a failed breakdown. And as this quote confirms, it's the context that makes it so important. Seeing this pattern pop up during a long downtrend, that's exactly what signals that the balance of power might finally be shifting from the sellers to the buyers. It's not a guarantee, of course, but it is a very strong signal to start paying very close attention.
Okay, another really powerful reversal signal is the bullish engulfing pattern. This is a 2-day pattern. So you have a day of selling, which gives you a red candle. But then the very next day, the buyers take complete control, pushing the price up so high that the body of the new green candle completely engulfs the previous day's red one. And again, context is everything. When you see a pattern like this form at a 52-week low, and a stock that has extremely high short interest, well, now you have a confluence of factors that all point to the same thing. A significant change in momentum might be happening right now. It tells you that not only has the selling stopped, but buyers have come in with overwhelming force.
So let's bring this all together and actually weigh the probabilities here. Given all the data we've looked at, we have two very, very different potential outcomes. And it's absolutely crucial to understand both the bull case and the bear case if you want to manage your risk effectively. Okay, here's the breakdown. The bull case. Some catalyst hits and it ignites that violent short squeeze we talked about. All the bad news is already priced in, so the risk to reward looks good, and a rush of buying could create absolutely massive momentum. Now the bear case. The institutions were right all along, their thesis plays out, the technical reversal signals fail, and the stock just keeps falling. Without a catalyst, the shorts feel no pressure at all to cover their positions. Both of these outcomes are possible, which is why you have to stay data dependent. And of course, I have to be crystal clear here. This analysis is for educational purposes only. The data we're looking at, especially short interest and price action, can and does change very rapidly. It is absolutely imperative that you do your own due diligence before you make any financial decisions. We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. You can sign up for Public to get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis. Remember, in these high volatility setups, preserving your capital is everything. Have a plan, know your risk, and as always, stay disciplined, stay liquid.